The story of Venezuela is often told as a failure of socialism, corruption, or mismanagement. But that explanation is incomplete. What is unfolding now is not just a political crisis. It is a financial and strategic event shaped by oil, debt, and the structure of the global system itself. Venezuela sits on the largest proven oil reserves on Earth. More than Saudi Arabia, more than Iran, more than Iraq. For decades, that oil should have guaranteed power, stability, and influence. Instead, it became the anchor that pulled the country under. To understand why, we need to strip away ideology and look at incentives. Oil does not simply create wealth. It attracts debt, foreign capital, and geopolitical pressure. Once oil becomes the foundation of a state, control over that oil becomes more important than the state itself.
Venezuela borrowed heavily against future production. Governments changed, but the structure remained. Oil revenues were treated as guaranteed income, long before the oil was ever extracted. This allowed spending to expand far beyond what the real economy could sustain. When prices were high, the system appeared stable. When prices fell, the debt remained. Over time, Venezuela's oil sector deteriorated. Infrastructure aged. Skilled labor fled. Production collapsed. But the financial obligations did not disappear. Bondholders, foreign creditors, and legal claims accumulated quietly in the background. The country became trapped between declining output and fixed repayment demands. This is the debt trap. Not a sudden collapse, but a slow tightening. Every dollar earned from oil became a dollar already promised to someone else. The state no longer controlled its own future production. It was already spoken for. At this point, Venezuela stopped being just a country. It became a balance sheet. Whoever could restructure the debt, reopen production, and control exports would inherit one of the most valuable energy assets in the world. That is where the United States enters the story. Officially, American actions are framed around democracy, stability, and humanitarian concern. But systems reveal themselves through outcomes, not language. The timing of intervention aligns with three pressures: global energy insecurity, rising geopolitical competition, and a debt structure that has reached its breaking point. Venezuela's collapse created an opening. Sanctions isolated the regime. Production fell to historic lows. Assets became distressed. Legal claims multiplied. In financial terms, this is the moment when control changes hands. Oil fields that once generated national sovereignty become collateral. Debt becomes leverage. Politics becomes the mechanism through which ownership is reorganized. This is not unique to Venezuela. It is a pattern repeated across history. Resource-rich states borrow against future output, lose productive capacity, and eventually lose control. The transition rarely looks like conquest. It looks like stabilization, restructuring, and reform. What matters is not who governs Caracas tomorrow. What matters is who controls the flow of oil, who restructures the debt, and who absorbs the long-term gains once production is restored. And this is where the gamble begins. Because intervening in Venezuela is not just about oil supply. It is about setting precedent. If debt and collapse can justify external control of resources, then the system becomes self-reinforcing. Financial failure becomes an invitation. The United States is not acting outside the system. It is acting exactly as the system rewards. The question is not whether Venezuela will change. That is already decided. The real question is who absorbs the risk now and who captures the upside later. And that question extends far beyond Venezuela. To see why Venezuela matters now, we need to zoom out. This is not happening in isolation.
The global energy system is under strain, and every major power knows it. Supply chains are fragile. Conflicts have fragmented production. Trust between producers and consumers has eroded. In that environment, oil is no longer just a commodity. It is leverage. Venezuela's oil is heavy, difficult to refine, and expensive to extract. But it is vast.
With enough capital, technology, and time, production can be restored. Whoever commits first does not just gain barrels. They gain influence over future supply when scarcity becomes political. But oil alone does not explain the urgency. Debt does. Venezuela owes billions to bondholders, energy firms, foreign governments, and arbitration courts. These claims are not theoretical. They are written into contracts, rulings, and financial instruments that never disappear. Even when production collapsed, the claims remained alive. This creates a familiar sequence. First comes sanctions, then isolation, then asset seizures. Finally, restructuring. Each step narrows the country's options while increasing external control. From the outside, it looks like pressure. From the inside, it feels like suffocation. At some point, a deal becomes inevitable. Debt is exchanged for access. Investment is exchanged for influence. Sovereignty is exchanged for survival. This is the moment where geopolitics and finance merge. For the United States, the calculation is not ideological. It is systemic. Allowing rival powers to gain footholds in a resource-rich, destabilized state is a strategic risk. Letting oil assets fall under alternative financial systems weakens dollar-based energy trade. Control over energy is inseparable from control over settlement. Oil, traded outside the dollar, challenges more than pricing. It challenges the structure that allows the United States to finance deficits, project power, and absorb shocks. Every barrel that settles elsewhere erodes that privilege incrementally. Venezuela has already explored alternatives. Oil for loans, non-dollar settlements, energy tied directly to debt repayment. These arrangements bypass traditional markets and weaken existing hierarchies. From a system perspective, intervention becomes defensive. But defense carries cost. Rebuilding Venezuela's oil industry requires massive capital. Infrastructure is degraded. Refineries are damaged. Pipelines leak. Human capital has fled. The timeline is measured not in months, but in years. During that period, instability persists. Markets react. Political legitimacy is contested. Local resistance grows. External critics multiply. This is why it is a gamble. If production recovers, the payoff is enormous. Long-term supply, strategic leverage, financial returns from distressed assets, reinforcement of existing systems. If it fails, the costs accumulate quietly. Prolonged instability, capital losses, reputational damage, escalating regional tension. And beneath all of it lies a deeper risk. The precedent. When debt failure becomes justification for intervention, the line between finance and force dissolves. Markets begin to price not just risk, but vulnerability. States with high debt and strategic resources are no longer just borrowers. They are targets. This changes behavior globally. Countries hedge, alliances shift, alternative systems accelerate. In trying to stabilize one system, pressure builds in another. Venezuela is not the end of this story. It is a signal. A signal that the era of cheap energy, easy debt, and uncontested systems is closing. What replaces it will be defined not by ideology, but by who controls assets when systems break. And the final outcome
will not be decided in Caracas alone. To understand who benefits from Venezuela's collapse, we have to follow the money.
Not the headlines, not the speeches, the contracts. Long before tanks or sanctions, Venezuela was already entangled in a dense web of financial obligations. Sovereign bonds, arbitration claims, oil-backed loans, unpaid contracts with foreign energy firms. Each one represents a legal right to future value. When a country collapses, these claims do not disappear. They become more powerful. Venezuela's debt trades at distressed levels. That is not a failure state for finance. It is an opportunity state. Distressed debt is where specialized funds operate. They buy claims cheap, wait patiently, then enforce them when conditions change. This is not theory, it is a documented strategy. Once political conditions shift, frozen assets can be unlocked. Lawsuits move forward, judgments are enforced, oil revenues are redirected. The value does not need to return to Venezuela for investors to profit. It only needs to become accessible. Oil is the enforcement mechanism. Venezuela's state oil company owns assets abroad, refineries, storage, subsidiaries. These assets have already been targeted in courts. When a government defaults, creditors do not negotiate with citizens. They negotiate with pipelines, tankers, and export contracts. Every barrel becomes collateral. This is why control over production matters more than ideology. Whoever oversees the reopening of oil flows controls the gate through which repayment travels. Energy companies understand this perfectly. Major producers do not rush into stable environments. They wait for leverage. When assets are cheap, governments are weak, and competitors are excluded, long-term contracts become possible. Access gained during collapse is worth more than access gained during prosperity. The same applies to infrastructure. Refineries, pipelines, ports, and shipping routes do not just move oil. They determine who captures value at each stage. Once rebuilt under new terms, those terms last decades. This is how wealth transfers quietly. But there is another layer: financial plumbing. Oil is not just sold, it is settled. Payments move through banks, currencies, and clearing systems. When oil is sold in dollars, the dollar system is reinforced. When it is sold outside that system, alternatives gain credibility. Venezuela experimented with non-dollar arrangements during isolation. Those experiments threatened established hierarchies, even if volumes were small. Precedent matters more than scale. Reintegrating Venezuela under familiar settlement rules restores more than supply. It restores alignment. From this perspective, intervention is not about seizing oil fields tomorrow. It is about shaping the architecture under which oil will move for the next generation. And that architecture determines who absorbs inflation, who finances deficits, and who bears instability. For Wall Street, this is a restructuring story. For energy firms, it is a long-cycle investment play. For the system itself, it is containment. But containment has limits. Every time collapse is monetized, trust erodes elsewhere. Countries with high debt observe the pattern. Resource-rich states see how vulnerability is priced. Alternatives are explored quietly, then more openly. The more aggressively the system enforces itself, the more incentive there is to escape it. This is the paradox at the center of the Venezuela gamble. Short-term control creates long-term fragmentation. If Venezuela's oil returns under familiar rules, the system wins a battle. But if the lesson spreads, the system weakens over time. That is why this moment matters. Not because Venezuela is unique, but because it is visible. The money is already positioned. The contracts are written. The assets are mapped. What remains uncertain is not whether value will be extracted, but how much resistance that extraction will generate. And resistance, once financial, does not stay financial for long. What happens in Venezuela does not stay in Venezuela. Systems do not work that way. They transmit signals. The first signal travels through energy markets, not immediately through price spikes, but through expectations. Traders do not just price today's supply, they price future control. Who will be able to produce, export, and settle energy when the next shock arrives? Venezuela represents latent supply, dormant capacity waiting for alignment. If brought back under familiar rules, it becomes a pressure valve. If kept unstable, it becomes a wild card. Either outcome reshapes strategic planning. But energy is only the surface layer. Beneath it lies money. Oil and money have been intertwined for decades. When energy is sold and settled through a dominant currency, that currency gains structural demand. It is not chosen because it is loved. It is chosen because the system requires it. That requirement allows deficits to be financed without immediate consequence. It allows instability to be exported. It allows debt to grow without collapse. This arrangement depends on participation. Every time a major producer exits or experiments outside the system, the architecture weakens slightly. Not enough to break, enough to notice. Venezuela, during isolation, began experimenting out of necessity. Alternative settlements, direct exchanges, oil tied to debt rather than markets. These were not efficient, but they were instructive. They showed that participation is conditional, not inevitable. Reintegrating Venezuela under the old rules would signal continuity. It would reinforce the idea that deviation is temporary and costly, that the system always reasserts itself. But the cost of enforcement is rising. Sanctions, seizures, and restructurings accumulate memory. Countries with high debt watch closely. Those with strategic resources pay attention. They study not the rhetoric, but the sequence. Borrow, overextend, lose capacity, face pressure, trade sovereignty for relief. This pattern is not hypothetical. It is played out repeatedly. What changes now is scale. Global debt levels are higher than at any point in modern history. Many states are structurally dependent on refinancing rather than repayment. They are stable only as long as confidence holds. Venezuela shows what happens when confidence evaporates. For some countries, the lesson is compliance. Stay aligned. Avoid isolation. Maintain access. For others, the lesson is diversification. Reduce exposure. Build alternatives quietly before they are needed. This is why parallel systems accelerate during moments like this. Not because they are superior today, but because they offer optionality tomorrow. The system does not fracture suddenly. It fragments at the edges. Each intervention stabilizes the center while encouraging movement at the periphery. Over time, those edges connect. From a financial perspective, this creates a more volatile world. Fewer buffers, more sudden shifts, higher sensitivity to political events. From a geopolitical perspective, it creates zones of contest rather than clear hierarchies. Venezuela sits at the intersection of these forces. It is not powerful, but it is symbolic. It demonstrates how debt, resources, and pressure interact when the margin for error disappears. And it forces a question that no system can avoid forever. How many times can collapse be monetized before the incentive to avoid the system outweighs the cost of leaving it? The answer is not immediate. It unfolds gradually. But every visible case accelerates the timeline.
Venezuela is one of those cases. The collapse of a system never feels dramatic while it is happening. It feels administrative, legal, technical. It arrives disguised as restructuring, stabilization, and reform. Venezuela's story fits that pattern precisely. What appears on the surface as a political intervention is, at its core, a transfer mechanism. Adaptations are reclassified, obligations are reordered, control is reassigned through contracts rather than conquest. This is how modern power moves. No empire announces decline. It manages it. It extends timelines. It monetizes failure where it can, believing that control today will outweigh consequences tomorrow. But history suggests otherwise. Every system built on compulsory participation eventually encounters resistance. Not ideological resistance, but mathematical resistance. Too much debt, too much enforcement, too little trust. When trust leaves, systems do not collapse evenly. They fracture. Some actors remain inside because exit is too costly. Others leave early and absorb short-term pain for long-term autonomy. Most hesitate, watching signals accumulate until choice disappears. Venezuela is one of those signals. It shows what happens when debt becomes destiny, when resources no longer guarantee sovereignty, when financial survival requires surrendering future control. For powerful states, this looks manageable. For weaker ones, it looks like a warning. The United States may succeed in restoring production. Markets may stabilize. Contracts may be enforced. On paper, the gamble may pay off, but the cost is cumulative. Each visible enforcement teaches others how the system responds under stress. Each intervention accelerates planning elsewhere. Each restructuring reduces the belief that participation is neutral. Belief is the true reserve currency. Once belief erodes, strength matters less than adaptability. Systems that rely on inertia lose advantage. Systems that offer choice gain it. This is why the most important consequence of Venezuela is not measured in barrels or bond prices. It is measured in decisions quietly being made in capitals around the world. Decisions about reserves, about settlement, about exposure. The world is not abandoning the existing system tomorrow, but it is preparing for a future where dependence carries higher risk. That preparation changes behavior long before collapse becomes visible. History shows that the final stage is rarely a single event. It is the moment when the system realizes it is being planned around rather than relied upon. Venezuela did not cause that shift. It revealed it. And once revealed, it cannot be unseen.